Let's summarize by reviewing what we've learned to do in each segment. We started out by thinking of central banks as institutions. We learned to identify the two key roles of the central bank, the bank of bankers and the bank of the government. We learned to identify the main elements of central banks' balance sheets, including assets, mainly foreign reserves and government debt securities, and liabilities, short-term liquidity, monetary liabilities, and longer-term non-monetary liabilities. We also learned to calculate required interest payments in interbank markets as a pro-rata fraction of annualized interest rates. We then constructed a model of interbank rates based on liquidity preference theory. Liquid assets used for interbank transactions are bank reserves. The demand for liquidity is determined by required reserves, transactions needs, and precautionary motives. In addition, banks will be willing to hold liquidity rather than lend it when interbank interest rates are low. The supply of reserves is managed by central bank purchase and sale of marketable securities, which is called open market operations. We learned to use T accounts to represent the marginal effect of transactions on balance sheets. We learned the two types of open market operations, outright transactions and repo transactions. These control liquidity in the long term and the short term respectively. We learned to model the effects of changes in the supply of reserves on the rate at which banks will be willing to borrow liquidity. When available liquidity is expanded, the cost of borrowing liquidity falls. When liquidity is reduced, the interest rate increases. We then learned the details of the implementation of monetary policy. The central bank sets an operational target for the interbank interest rate. They do this by setting a policy rate for regular liquidity operations conducted using repo transactions. On a daily or weekly basis, the central bank lends or borrows liquidity from commercial banks at the policy rate. This allows them to reduce liquidity when the interbank interest rate is below target and increase liquidity when the interest rate is above target. These operations guide the interbank rate toward the policy rate, helping to achieve the target. To reinforce the operational target, the central bank creates an interest rate corridor with a set of standing facility arrangements, which allows banks to adjust their own liquidity whenever the interbank rate deviates too far from the target. The central bank policymakers can then adjust the operational target simply by changing the position of the interest rate corridor when required by economic conditions. We have also seen how the central bank can set very short-term interbank rates. We can then consider how to calculate the effect of the operational target on longer-term rates. Over a period of time, money market lenders earn interest on each day of lending. We decompose any loan into the average of the interest rate earned on each one of those days. This interest rate should be equivalent to the policy rates on that day. Therefore, longer-term rates should be shifted by market expectations of future interest rates. Thank you for completing Module 1. Now that we understand the implementation of monetary policy, which governs liquidity in money markets, it will be time to turn to Module 2, which will discuss policy strategy, which governs liquidity in the broader economy.